You see people posting huge gains online, and you hear friends talk about quick wins. It feels incredibly simple to just download an app, buy a coin, and hope it goes straight up. But this mindset is exactly how many new traders get hurt and end up losing money in their very first few months. Today, we are breaking down the absolute top crypto beginner mistakes to avoid so you don't become just another statistic in the market. Crypto feels wildly exciting when you first hear about it, especially when your social feeds are full of charts and bold claims. It can feel like you need to jump in right now or you will miss your chance forever. The good news is that early losses are not just bad luck. They are clear, avoidable patterns that you can spot in advance when you know what to look for. By understanding these patterns, you can start your journey with fewer traps, significantly less stress, and a much better chance to actually stay in the game. In this video, we are going to dive deep into the most common crypto beginner mistakes. We will cover everything from how hype leads to terrible buys, to how a simple, well-thought-out plan can protect your hard-earned money. Let's dive in. The very first set of crypto beginner mistakes to avoid revolves entirely around speed and the fear of missing out. New investors constantly rush to create accounts, rush to fund them, and rush to buy whichever coin happens to be pumping that exact day. This quick pace feels exciting, but it completely removes your time to think logically. Fear of missing out, or FOMO, leads people to buy when the price has already run incredibly high. Have you ever seen a sharp green candle on a chart and felt that waiting even one more day means you will miss the boat entirely? You are definitely not alone. But here is the reality: many who buy at these extreme peaks do not hold through the inevitable drop. They panic, sell near the low, and then repeat the exact same pattern with a new token. This vicious loop drains both your money and your mental energy. Recognizing FOMO, naming it, and stepping back for just one day can break that loop and save your portfolio. Another of the major mistakes beginners make in crypto is blindly chasing hype from influencers. A person with a large channel posts a coin, calls it the next big thing, and newer traders rush in without doing any checks. In many past cases, the coin had very thin trading volume and large insider holdings that were simply sold off the moment new buyers arrived. Remember, paid promos are often hidden, and so-called alpha calls might just be exit plans for early holders. Treat any public tip as a starting point for your own research, not as an immediate signal to act. If a project appears in every short video clip at once, treat that as a massive red flag and absolutely not a green light. This brings us directly to a massive trap: ignoring basic research, often called ignoring DYOR, or doing your own research. People easily trust random tips from strangers or slick clips instead of checking the actual project site, the team behind it, or the token details. They don't search for past hacks or legal trouble. Are you blindly trusting the coins your friends suggest in group chats? All it takes is 30 minutes of simple reading before you risk any of your money. Even basic checks would stop many new traders from buying into weak or fake projects. If you cannot find support from at least 2 neutral sources, you should wait or completely skip the trade. Furthermore, do not trust that past price moves prove future safety. Many coins that held massive value for years later dropped and never came back as markets moved to new themes. Focus on the use case, active users, and project health instead of relying on old price lines. Now, let's talk about something that can wipe out your entire portfolio overnight: poor security. Ignoring basic safety ranks incredibly high among the most common crypto beginner mistakes. New users constantly reuse weak passwords from old sites, skip 2-factor checks, and log into exchange accounts over open public Wi-Fi. Many leave all their coins on one single exchange with no extra security steps, or they store seed phrases in clear text in an email or cloud notes. When a phone is lost, a hard drive fails, or a fake site steals login data through a phishing link, those funds vanish for good. The simple rule, not your keys, not your coins, absolutely still holds true today. Your long-term funds should sit securely in a safe offline wallet, with seed words protected on paper and logins guarded with strong, unique passwords and 2-factor codes. Take a second right now. Are your current crypto accounts secured with a 2-factor authentication app? If not, make that your absolute priority as soon as this video ends. You also need to avoid making crypto mistakes to avoid as a beginner regarding your choice of platform. Do not sign up with small, unproven sites just because they offer lower fees or better sign-up bonuses. Later, when you face a stuck withdrawal, you will find there is no clear support path. Always favor large, licensed exchanges because safety and clear rules matter far more than a tiny edge on price. A hidden danger that catches many off guard sits around taxes and record-keeping. New traders often think only the final cash out to fiat currency will matter for their taxes. In reality, in many places, each trade, swap, or use of crypto can trigger a taxable event. Traders often wake up at filing time with absolutely no records, no cost base, and a massive surprise tax bill. If you log your trades from the very start and use simple tracking tools, you completely avoid this knot. This also has a great bonus effect. You will likely trade less often, since each move now carries a clear, documented cost. Moving into portfolio management, going all in on one coin is a massive error. Whether it's a large name like Bitcoin or a tiny meme token found in a chat, a single bet ignores basic risk spread. When that coin drops by half, your whole crypto stake drops by half. A small basket of researched coins is much safer. One of the classic crypto investing mistakes for beginners is ignoring position size entirely. New traders think in coin counts instead of actual money at risk. A great pick size too large can lead to incredible pain, while a weak pick size small might just teach you a cheap, valuable lesson. Keep each new trade at a size that your budget and nerves can actually handle. Start so small that any loss would be just an annoyance, not a financial crisis. Beginners also fall into the terrible habit of overtrading. They feel that real traders must act every day or even every hour, jumping from coin to coin at the slightest market move. Each trade brings fees, spread costs, and tax effects, and each quick exit cuts off the chance for a solid long-term gain. Constant tiny trades can slowly drain an account even in a rising market. Are you checking your charts every few minutes and letting small moves dictate your mood? That tension pushes you into poor choices at both highs and lows. Setting clear times to check your account, like once per day or week, gives your plan room to work and protects your stress levels. And please avoid using complex tools like margin, futures, and options too early. These promise higher gains but bring incredibly quick, deep losses. A strong rule to live by. If you cannot explain leverage in simple words to a friend, you should not be using it yet. Many also suffer from a poor match between their trading style and their actual life. People try to day trade penny tokens while working full-time jobs and handling family life, which leads to missed exits, late entries, and massive stress. If you have a busy life, you are likely far better off with a long-term buy-and-hold plan for a few high-quality assets. There is also a massive issue with time frame mismatch. People say they are long-term, yet they act on every single daily headline, selling after one bad week due to fear. You must decide at the start if you are a long-term holder or a short-term trader, and then pick tools that match that choice. Finally, you absolutely need a clear exit plan. Traders often know exactly how to enter the market, but not how to leave. Decide your exit rules before you feel strong fear or joy. Set a specific price or risk level in advance and stick to it, because emotions will warp your choices when the market swings. Treat crypto as part of your wider financial picture. Keep it separate from your savings and rent, and never trade with borrowed funds or credit cards. If your financial base isn't steady yet, your first step is fixing that base, not buying more coins. When you look across all of these lessons, the core themes are incredibly clear. Slowing down your actions, creating clear written plans, and practicing basic safety habits will remove almost all of these traps. You have seen how FOMO, poor research, and mixed goals feed into common crypto beginner mistakes. This isn't magic. It is simply steady money sense applied in a new digital space. Remember, most people want growth, skill, and control over their money, and you can achieve that without chasing every single new coin. If you avoid the big crypto mistakes to avoid as a beginner, and give your plan real room to work, you will stay in the game long enough to learn and adapt. The ultimate aim is not making perfect calls every time. The aim is to still be here many years from now, calm and prepared, with your money and peace of mind completely intact. If you found value in this breakdown and want to master your investing journey, Please hit that like button and subscribe to the channel for more strategies. And before you go, I want to hear from you. What was the very first crypto mistake you made when you started out, or what's the one you're most afraid of making right now? Let me know down in the comments below. Keep learning, stay safe out there, and I will see you in the next video.